Good evening, everyone. My name is Janice Mathis, and tonight we are broadcasting from the historic Dorothy Irene Height building at 633 Pennsylvania Avenue, halfway between the White House and the United States Capitol. Welcome to Women's Empowerment Program, a monthly webinar series sponsored by the National Council of Negro Women. Tonight, my task is to introduce the moderator of our session. She has already made such a huge difference in our work here at NCNW, and we're so proud of her and so pleased. She is our Tech Telecom Fellow, where she works on telecom and technology policy. Ms. Celeste McCall is a member of the Bar of the State of New York. She is a graduate of the University of Miami School of Law, where she earned a JD, or Juris Doctor, in May 2016, and went on to earn a Master of Laws degree in Entertainment, Arts, and Sports Law in December 2016. Her activities in law school included the Society of Bar and Gavel, the Intellectual Property Law Society, and she worked in the Miami Law Innocence Clinic. She was a member of the Entertainment and Sports Law Society, and she competed in their baseball arbitration competition. She did her undergraduate work in English at St. John's University, where she was an honors student, graduated cum laude, and was a recipient of the prestigious Academic Achievement Award. She did something that I never did. She was on the dean's list for 4 semesters. Her activities included a member in the Sigma Tau Delta Honor Society. She worked as a lawyer at Aronson, Rappaport, Feinstein, and Dutch in New York, where she was an associate attorney. We're so glad that she was able to join us. She also clerked for MMTC, the Multicultural Media, Telecom, and Internet Council here in Washington. She also clerked for Goldberg and Hirsch. Tonight's moderator is Ms. Celeste McCall.
Oh my goodness, being introduced is so overwhelming. Thank you so much, Ms. Mathis. I really made my evening. So I'm actually honored and really, really excited to introduce the presenter of tonight's webinar. I think she's amazing. Her name is Lauren Washington. And Lauren is the co-founder and CEO of Keep Up, and also the co-founder and COO of Black Women Talk Tech. Throughout her career, Lauren has been on the cusp of innovation and digital strategy in various industries and over a multitude of brands. She helped drive some of the first social media and mobile marketing efforts early in her career at both InStyle Magazine and TVGuide.com. At Neutrogena Cosmetics, Lauren worked in the innovation department to guide the development and launch of new products. As an in-house consultant for Omnicom Group, she rotated through DDB, Interbrand, PhD, and Sterling brands, creating and bringing brand strategy to life for top global companies. In her most recent role as the Director of Strategy at the digital and social media firm Attention, she led a department of qualitative and quantitative research and strategic planning for all clients. As CEO of Keep Up, Lauren is focused on the long-term vision and strategy of the company, while also overseeing everything from inception to the day-to-day operations. Keep Up was one of 11 winners out of 7,000 applicants for the 43 North competition, the largest global business competition, winning $250,000 and a year of office space and mentorship. In 2017, she co-founded Black Women Talk Tech to help Black women create billion-dollar tech companies. Through its conferences, workshops, and promotion of Black women in the industry, it's impacted over 500 tech founders and helped get 13 funded. Lauren received her Bachelor of Arts from the University of North Carolina at Chapel Hill with a major in journalism and mass communication, and her MBA from the Kellogg School of Management with majors in entrepreneurship and innovation, marketing, and finance. She was the board vice chairman of the nonprofit, the Global Language Project, the head of the Social Impact Committee in the Kellogg Alumni Club of New York, and a management leadership for Tomorrow mentor. Thank you so much, Lauren, for joining us and presenting this topic today.
Thank you so much. That is actually very overwhelming to hear it all at once, but I am so honored to be here as well and so excited to talk about this topic where I'm incredibly passionate about. So I'm just going to pull this up really quickly. And so I really wanted to share what I've learned throughout my time running Keep Up and also running Black Women Talk Tech about how to use capital, how to raise money in order to build these scalable companies. So as Celeste mentioned, I've been building my own scalable company for the last 4 years. I was able to pitch and win $250,000 through the 43 North competition. And then last year when I started Black Women Talk Tech, what we realized is that not only do we have a number of incredible women who are building companies, but we also got a lot of people who came to us at the very beginning stages who were confused about this whole process of raising capital and raising money and understanding your options. So that's what I really want to go through and sort of demystify for you these days. So first thing first, what is a scalable business in and of itself? And we get this question all the time. So for me, a scalable business is really something where you can make money in your sleep. That is how I define it. If I go to sleep and I wake up the next morning, are there more dollars in my bank account? The way the industry really looks at it is, are you bringing in revenue based on the number of people who are working for you? So for example, if you're in consulting, you know that when you're a consultant, you're giving your expertise, you're giving your skills, and it's really a one-to-one basis based on what your output is as an individual and what money you can bring in. So if I'm a consultant and I go to sleep, I know that I'm not creating those decks, I'm not talking strategy, I'm not giving advice, and therefore I can't scale my business unless I bring an additional person in to help me do that. On the flip side, if you are building a tech company, say you build Amazon, right, and you have this platform that is automated, you know that when you're on those crazy Amazon shopping sprees at 1 a.m., which I've definitely done many times, that is always going to go through. And it doesn't take a person sitting there clicking yes on your Amazon order for it to happen. That is a scalable business. That is the person who is making money in their sleep. Jeff Bezos is going to wake up the next morning with my money in his bank account. So that's how you sort of look at these. Another way to understand it is looking at products versus services. So for a service, you know that that's something where it's incredibly valuable, but you know you really have to give that as a person one-on-one versus a product. So it could be a tech product, but it could also be something like Spanx. If you think about Sarah, who built out Spanx, she built $1 billion company because after she developed that one product, she knew she could sell that product over and over and over again, and she didn't need additional people in order to do it. So now that we know what a scalable business is, what do we look like within this industry? How do Black women fare? And to be honest, there's good and bad. So we are definitely overqualified and underfunded. So for Black women, the good news is that we are one of the most educated demographics in the United States. We are growing businesses at the fastest rate of any demographic in the United States, meaning that 1 in 7 businesses are owned by Black women. That is just insane to me that we are growing that at that rate. It means that we're growing it twice as fast as anybody else. And we're also bringing in a lot of revenue as well. We're bringing in $52 billion. This is the statistic from 2016 in terms of all of those companies. And we're not only bringing these in terms of revenue, but we're cultural tastemakers as well. We all know that we influence our families' buying decisions and our community buying decisions. And we have a lot of power. We have billions of dollars of economic power that we can use and create businesses around that. But on the flip side, when you look at the tech industry and you look at these scalable businesses, we're really just not getting our due. So only 34 women have raised over $1 million in funding, and $1 million sounds like a lot, but when you realize that the average person raises $1.4 million for their company, and on average we're raising $36,000, that statistic is pretty abysmal. That's 3.5%. That we're raising in terms of capital. So we're literally raising pennies on the dollar for these companies that we're building. And if we don't have this type of capital to push us forward, we're never going to be able to compete. If I, as a business, have $30,000 in my bank account and my competitor has $1 million in their bank account, who do you think is going to go further? Unfortunately, we've been able to do it, but we need to really understand how to raise more money and what this whole industry looks like so that we can compete in those same levels. So I don't say this really to discourage you from raising money or to discourage you from going into this, but I say it so that you understand that the stakes are different for us. And I wish this is something that I knew when I first started building my company, that even though on average people say that it takes 90 days to raise money, what I'm hearing from the 500 women that we have as members in Black Women Talk Tech is that sometimes that's actually really 2 to 3 years. And so understanding the difference in experience means that you will prepare yourself in a different way. So let's talk about what we need to know about raising. And I'm hopefully going to do this in 5 quick steps. So step 1 is really learning about the types of capital that are out there for you. And this is so crucial. I actually just had a conversation today with a number of Black women tech founders, incredibly successful. But what we were all saying was that we wish we knew our options before we started. And that's so important because even though it seems like there's all this free money going around, that's not actually true. There's always strings attached to every kind of money you're going to bring in. And you really have to understand what your company goals are and what your personal goals are before you take any kind of money in. So it's really crucial to understand this, and I'm actually going to do the next 2 steps on this because I think that I would have approached my companies differently, and I know a lot of women who would have as well, if we understood what the benefits of this were and what the sacrifices of raising money were. So there's 3 different pieces here. The first type is equity, the second is debt, and the third is this whole category I threw into other that's actually really growing pretty significantly and has a lot of opportunity there. But the first 2 are more traditional. So for equity, these are ways where you're giving money, you're getting money and giving a piece of ownership of your company for that money. So for example, if someone gives you that $1 million check, they're taking, let's say, 10 or 20% of your company. That's really important to understand because that person is now really your co-founder. That person is a part of your company and has a say in everything that you do moving forward. And so this can look a couple different ways. The first is that you could have friends and family. So this is exactly how it sounds. It's literally your friends and family coming together, giving you money in order for you to pursue your dreams. Then there's angel investing. Angels are those who are have started their own businesses, most likely, or have made a lot of money in their own industries and then want to give back. So they are also giving back and sort of taking a risk on you and want you to build your dream, but they know that they're going to make money. So there's a different expectation there in that they want to make money when giving it to you, but they'll still come in a little bit early in the process. Then there's equity crowdfunding. So equity crowdfunding are like sites like Republic. So I'm not sure if anyone knows about Republic.co. They do equity crowdfunding, basically taking a lot of people's money and then putting it all together in order for you to take that and build out your business. And then lastly, there's venture capital. So venture capital is when you hear of all these companies who are raising $100 million. That's coming from venture capitalists. They are basically using other people's money in order to fund your business. So that money can be coming from different institutions like pension funds or foundations or colleges and universities. And they're taking that as an investment vehicle, putting it in your company, and they better see returns. So they know that they're getting their money back basically when they take that chance on you, or the risk is much less. Then there's debt. So debt is a little bit more traditional. It's kind of what you hear when you get a bank loan and you want to open up your restaurant. So these are things where you're not giving a piece of your company, but you know you're going to pay this back at some point. Microloans like the site's Kabbage will give smaller loans and they kind of put it all together in order to push your business forward. Crowdfunding loans, this is something that when Roshana comes on, she can talk to as well. This is really where it's similar to the equity crowdfunding. People come together, keep that loan, and bring it back. Then there's government as well, which I think we're all pretty familiar with. And then there's revenue sharing, which is actually pretty new. And what that is that someone will give you money and then you will pay that money back based on the revenue that your business. So every time you make a little bit of money, you give a little bit of it back. And then there's this other area. And so there's this idea of bootstrapping, which we hear all the time within the industry, which means that whatever money that your company is making, you're taking that profit and you're putting it back to invest into your business. So it's not that you're getting any new money, but you're kind of making money from the beginning and you're taking it in order to better your business, do more R&D, and really take it to that next level. Then there's self-funding. This is where, is there someone asking a question?
Yes, no. Your slides are not advancing, so please forgive the interruption, but you got such a beautiful presentation. Can you advance your slides?
Are you seeing the types of fundraising slide?
No, we're only seeing your title slide. Have you advanced it?
I did. Apologies. Let's see.
There we go. Now I'm seeing the second one. Catch yourself up. Audience, please, please forgive us while we, there we go. She's got such a beautiful presentation. I just couldn't let it go by. Okay.
Sorry about that.
All right, now.
Apologies.
I'm
okay.
sorry for the interruption, but I didn't want our audience to miss the beautiful presentation you put together. Thank you.
Of course. Thank you so much. I apologize for that, and you'll have these downloaded as well, so you'll be able to see the other slides. So we're in the other section of the types of fundraising. I just went over bootstrapping, and then there's self-funding. So self-funding is really when you've saved a chunk of money or you have a good amount of credit, and then you use that to build out your business. What I will say about self-funding is that this is often where Black women fall. Unfortunately, we know that Black women have are more likely to put costs from their businesses on their credit cards and therefore go into debt. And so unfortunately, this may work for some people who have unlimited funds or have a really great safety net in terms of money, but it's not the best option if you're trying to build out a really big business. Then there are grants as well. Grants are really great because most of the time they don't take equity or debt. There's traditional crowdfunding. These are sites like Kickstarter, where you're not really giving a piece of your company, but you're giving maybe a product or a discount in order to get that money. And then there are things like ICOs. So this is initial coin offerings, a whole new cryptocurrency world where you basically create a coin. People use their cryptocurrency to buy into that coin, and then you could take that money or that cryptocurrency to sort of build out your business. So step 2 of this whole process is really determining which of these are right for you and for your business. And so this goes back to what I was talking about, where you have to understand what your long-term goals are before you bring in money to your business, because they all have some sort of consequence, but they all have really great benefits as well. So taking these 3 different types of fundraising, there's equity fundraising, debt, and other. And so with equity fundraising, this is where you know you're building a scalable business. It is not a question. You know that your company is going to make money in your sleep. You want to be the next Amazon. You want to be the next Facebook. You want to build up as much as you can so that when those people give you money, if they're giving you $1, they expect $5 to $10 back. So for every dollar that they get, they want to know that you're going to create so much value in this company and you're going to grow so large that they're going to get a return on that money. So keep that in mind when you're raising $1 million. It sounds really exciting, but then you're held to the fact that you have to bring back $5 or $10 million for that individual investor. And you do this through an exit. So this is also really important to understand when you're building out your company. So understanding whether you're ready to let go of your company at some point is really crucial to understanding the equity conversation. So when I say exit, I mean that you are creating some sort of liquidity for your company. That means that you are selling to another big company. So for example, that's WhatsApp or Instagram, who sold to Facebook for $1 billion. That was an acquisition where they exited and they got money back for that. Or this is very rare now, but they are IPOs as well. So Facebook is one of the last, recent companies that had a huge IPO, which means that you go into the public markets. But in any instance, this means that you are really not the owner of your company anymore, right? Either that company who bought you is now your owner and your boss, or the market and the people are the owner and the boss as well. And so you have to really understand that long term, if you want to be the boss and you don't ever want to let go of your company, don't take investment as equity. The second piece is debt. So for debt, what you really need to understand is that this is when you need a huge chunk of upfront capital to get started. If you're taking debt, you know that you're probably going to make revenue fairly quickly. You know that I just need this money in order to get the lease on this retail space, or I need this money in order to rent my restaurant equipment in order to get started. And I know that as soon as I open my doors, I'm gonna be making money and I can pay that back. So you're not really building something where you're going to need money over and over again in order to grow and build your business. You know you need that upfront flush of cash, and then you'll be set moving forward. Another piece of this is that you need to have assets for debt. And this is why a lot of tech startups go the equity route, because they don't really have traditional physical assets where if I don't pay that debt back, then you can come and seize my car, or you can come and take that space that I bought, or you can take my restaurant equipment. For tech companies, they're not going to take a website, right? The website in and of itself is not really valuable. So they don't have anything to sort of fall back on, which is why when you hear about tech companies sort of taking this equity and raising money this way, that's really why. And then the other section where you go for grants, or where you decide to do crowdfunding, or you do an ICO, this is really when you don't want or need other investors. It's a really empowering, individual, free feeling kind of way to start your business. Or you're not really ready to take on debt or equity. It's a great way to really get started on your business when you're testing something out, but you're not ready to really commit to a really high debt, or you're not really ready to bring in equity and take on that burden of that either. So step 3 is figuring out what the motivations are of these investors. And the answer always is returns. So let's say that we've decided to build a scalable company. We know that we want to take this investment. We're ready to move forward, and we're ready to go the equity route. Everyone in that section wants returns in some way. But you have to understand that in these different types of investors want different types of returns. So for example, if you are getting money from friends and family, as I mentioned, they're there to support your dream. Like, they are there because they love you, because they believe in you, because they want you to succeed. They're not necessarily there for those financial returns. They're willing to take the financial hit early on if it doesn't work out, because they're invested in you as a person. This is slightly true, as I mentioned, for angel investors as well. A lot of them tend to invest in their communities. A lot of them tend to invest in people who look like them, so they tend to invest in women if they're women, or a lot of Black people like to invest in minorities. And they're really doing it not only to get a little bit of that feeling of giving back. You know, a lot of these are people who have been through their careers already, and they've already been successful, but they want to give back, but it's also a business for them. It's an investment for them. They want to make sure that they're making money in the future, which means that when they take money, when they take equity, it's going to be a little bit more. So they may take larger chunks because they're taking those bigger risks. And then for venture capitalists, this is all about cash for them. it's not personal if they're not interested, because they're really just looking at the numbers. They have a duty to those who they're taking money from and investing in to give those returns back. So it's not necessarily that I don't like you and I don't like your business, but if I don't think that based on the growth that you've had, that you're going to knock this out of a park and be $1 billion business, then I can't put that money in, because then I'm putting, the kindergarten teachers' pension and 401k on the line. So step 4 is really figuring out where you fit into this fundraising cycle. So I know I've mentioned all of these different people you can go to for money, but this is really understanding where you should go, when you should do it, who you should reach out to, and when you should reach out to those specific people, because there is a flow to this. And having been in Black Women Talk Tech and talking to these different investors and talking to these different founders, what we realize is that we often have these consulting firms who are really great and they're killing it, but they're going to talk to venture capitalists. And venture capitalists, as we talked about, are not in the business of funding companies that are not scalable, companies that are not going to give them that return and where you're not going to exit. And so if you give your pitch deck or you approach a venture capitalist as a consulting firm, you're not going to get even a meeting. And unfortunately, you can kind of get blacklisted from the community because you don't understand necessarily how the whole process works. And so that's what I really want to break down here on this very intricate slide, but we're going to go step by step so that we understand exactly where you come in and when you should be raising at these different levels. And this is something that took me really years to understand, to be honest, because it's not really information that's out there, and it's not information that's passed down to the community very often. So starting at the very beginning, this is the idea stage. This is where you have this really great idea, you're so pumped and excited, you're writing this down on a napkin, maybe you've put your pitch deck together, you've probably brought a couple people who are also gonna help you build this out together. This is really the idea stage. You haven't done much, but you're moving forward. And this is where that friends and family comes in. They're taking that huge risk. They're going to give you that money in order to help you succeed. This is also where I want to pause a bit, because as I mentioned before, oftentimes Black women skip this part, because for our communities and in terms of the wealth that we have, how many of us can really go and ask their friends and family for $1 million? It's just not really heard of. And I know women who have done it, and that's great, but on average, for most of us, we don't have these friends and family rounds. We don't have that rich uncle who's gonna write that check for 100K. And so the reason why I put it in here is for 2 reasons. First, you can actually sort of switch out this friends and family round for one of those other pieces. This is where you bring in your grants. This is where you do your crowd fundraising. This is where you have these other ways to raise money that don't come out of your pocket, because when it comes out of your pocket, it means that you are depleting your overall wealth and you are not really raising wealth because you're starting in a negative. So that's one reason why I bring this up. The other reason is because oftentimes you'll have investors at the later stage ask you about your friends and family. And they're not asking necessarily to see how much money your friends and family have, but they're asking to see, is there actual interest, and are there people out there who are going to take a chance on you? Are you that person who inspires other people to follow? And you can do that as well with these crowdfunding rounds, and you can do that as well with grants. Those are also ways to show that you're a leader and you have a great idea. The second stage is R&D stage, which is research and development. This is when you're actually developing out your business. You have a little money from friends and family. You're taking that and you're creating the first version, or the MVP, the minimum viable product of your app, right? And so this is where the angels come in. They see that you have your idea, you have your team, and you now are developing something that you can actually take to the market and see if people want. This is where angels come in and take, like I said, that larger chunk of your equity, because they're putting a little bit more risk in. They haven't really seen this proven out, but they believe in what you've done so far. And those angels are really going to put in, let's say, about anywhere between 25 to 200K of their own money. You can go to a group like Pipeline Angels or Golden Seeds or Harvard Angels, where they will pool their money together and you might get a bigger round. You may get $1 million here, but that's really as big as your angel round normally gets. That's until you go to the next round, which is your seed round. And this is where your company needs to have that initial traction. And so what traction is, it can mean a lot of different things. I've heard people spin traction in a ton of different ways as founders, but really what it means is generally these investors are looking for either revenue or they're looking for customers. They want to know that someone is willing to buy or use that product. And so when you have a number of people, not just your grandma and not just like your friend who's using your product, but you have outside people and you've built up traction and it's growing every single month, month over month, then that's when the seed round comes in. And so the industry has shifted a little bit in the last couple of years, where you used to sort of get your seed round from angels, and that can still happen. But now there are actually seed firms where you can go and they're writing those $1 million, $2 million checks as well. And they're taking that money, again, like these venture capitalists, from other people and investing it in your company. And then the fourth place is growth. So this is where you go to those venture capitalists and you're seeing that consistent growth. Your company not only has those users, but it's growing 10, 20 times every single month. And they're comfortable enough with your growth and with the strategy of your business that they're going to put in those big, big rounds to get you to that next level, to create that global business, to create the next Uber, to really grow your business and move forward. These are typically much harder, obviously. They sort of peter out as these different cycles go through. But once you're in here, these are rounds called the Series A, the Series B, D, and all the way through until you have that last stage, which is the exit. And so that, again, is where you either have that acquisition or you have your IPO, and then you're really back out into the market. The exit, like I mentioned, is so important, not only to understand whether you're willing to let go of your company long term, but it's really important because after you exit, that's when every single one of these people make money, including yourself, right? So you may have been able to make money and pay a salary throughout this whole time, but this is where you actually create value and you create cash for your friends and family, for those angels who took on that chance for you, for the seed round, for the venture capitalists. That is why that exit is so incredibly important, and it's so incredibly important to know from the beginning that you're heading there. And so once you've done this, this is step 5, and this is so crucial as well, and it's something that I really wanted to put in here because what we've seen also from investors is that oftentimes founders sort of fall off the map once they get money. They feel like that's the end. I got my $1 million check. I'm so excited. Now I'm just going to have and build out my company the way that I want. And that's not true, because obviously it's a two-way street, right? As I mentioned before, there's something that they want in order for them to give you money. And one thing that you need to do as a founder is really keep them updated on everything, the good, the bad, the hard, the ugly, everything towards while you're working towards these different returns. This is really important for Black women as well, because we sort of go into this mode of being a superwoman and not wanting to ask for help and not being vulnerable to show that we're struggling or showing that we're failing. And this is really important to know because investors can come in and help you, right? They are just as invested in your business because they have all this capital tied up in it, and they really want you to succeed. So don't look at it as you gave me money and now I'm gonna run off and take my business. This is a relationship that you can build. They can give you advice. They can give you introductions to people who can join your team or who will give you more money. And if you build up a really great relationship with them and they can also give you additional investment later. You always want to get that additional investment instead of having to go back out and raise, because it's that much harder. So understanding that once you raise your money, you're moving towards this exit, but you're moving together with your investors, and don't be afraid to then ask for help and then ask to bring them in. Is the end of my excited to take any questions from anyone and clarify. I know that was a lot, so happy to bring in questions now.
Okay, Lauren, your video and audio is going out a bit toward the end. I think we may have. Oh, hey, Michelle. Hi.
Can you still hear me?
Yes, I can hear you. Lauren, are you still there?
I'm still here, yes.
Oh, okay. All right. Your video and audio is going out a bit toward the end, but now I can see you clearly and perfectly.
Okay, great.
Okay.
Let me know if you'd like me to go back and redo anything.
Okay. So, hi, Roshana, everyone. This is Dr. Roshana Novelis. She is joining us. Thanks for joining us. Dr. Novelis is the founder and CEO of Enrich Her, a financial technology platform that helps women get funding to grow incredible ventures. The current Enrich Her initiative will help 197 women-led businesses attract $50,000 in debt-based capital through cohort-based programming in Atlanta, LA, Houston, Baltimore, and DC. Dr. Novelis, is a gender equality advocate who believes in economic empowerment and inclusive economic growth. Dr. Novelis holds a PhD in systems engineering with a minor in finance and Masters of Science in Information Technology, emphasizing information system engineering, a Bachelor of Arts in Business Management Economics, and a Bachelor of Science in Computer Engineering, achieving summa cum laude in each. Dr. Novelis has been featured in Fast Company, Forbes, and Black Enterprise. She serves on the Commission on Women for the City of Atlanta and was honored as one of the Women Who Means Business by the Atlanta Business Chronicle, one of the 40 Under 40 by Georgia Trend, and is a Halcyon Fellow for Social Impact. Thank you, Dr. Novelis, for joining us.
Thank you, Celeste, and thank you, Lauren, for sharing all of that amazing information. I'm just here to add some input from the Q&A section. So I've been on both sides of the equation, from raising funds for my startup and helping other entrepreneurs raise money for their companies, as well as the fact that Enrich Her helps women with debt-based financing for their companies. And our immediate goal is to help 197 companies, as you mentioned, Celeste, but our ultimate goal is to help over 10,000 women-led businesses get access to capital. So I'm happy to be part of this webinar.
We're happy to have you. And thanks to Lauren, we know what debt-based income and fundraising means.
Yes.
So let's get to the questions. William, do we have any questions from the participants? Can hear me. Okay. Let's see.
Oh, can you hear me now?
Oh, I can hear you now.
Okay. We do not have any questions. You may want to remind participants that you can either hit the icon to raise your hand, and we'll try and recognize you to ask your own question, or you can type a question into the question pane and hit submit, and we'll send your question to Celeste, and she can ask it of tonight's presenters. But we got one hand up now. Let's see who has raised their hand.
All right.
Hold on for 1 second.
I have questions too.
Ms. Brown Felder.
Yes. I'm in the process of, my name is Phil. I'm in the process of, can you hear me?
Yes.
Yeah.
I'm in the process of starting a new business, Lord and Heal, which requires, I've completed my business proposal and now I'm in the process of looking for investors. It's uh, uh, and so I want to refer this question to Dr. Novelis, who those 190, I believe, companies, are any of them focused? I'm in Nashville, Tennessee. Does it require me to be in one of those cities to get the support that you have mentioned?
So actually, we're open to women-led businesses nationwide. We do require that the businesses have at least $100,000 in financing, have been in operations for over 6 months. Beyond that, both Lauren and I send out opportunities every month on the different grants, fundraising sources, and fellowships that are available. So there's a lot of money out there that everyone on this call may be eligible for. But for my program specifically, you have to have those minimum requirements.
$100,000 and 6 months in business?
Yes.
Okay, that's what I needed. Thank you.
Okay, great. Thank you for your question. We have a couple more. This question is from Kenya Williams. She asks, can you give us the contact information about obtaining financing for women-owned businesses?
I can give you my contact information, and I'm sure Roshana is happy to provide hers as well. In terms of finding funding, it really is about sort of going out and doing the work. There's not too many places where I can just point you to one thing and say, this is where you can get money. There's money everywhere, truly. You just have to understand, like I was saying, where you fit into each of these different categories in order to know where to go. So as Roshana was saying, Black Women Talk Tech sends out a newsletter twice a month where we aggregate all of these different opportunities in order to show you where the grants are, where are these pitch competitions, where are people looking for founders who are doing something like what you're building out. And we're trying to pull it all together, but it really depends on exactly what type of money you want to raise and where you are in that process. And Roshana, I don't know if you want to add to that as well.
Yeah, and I just wanted to say a lot of people think that you have to be really good at pitching and presenting to actually raise capital. But I personally, for my company, I've never won a pitch competition. I always get second place for the ones that I've participated in. So I've raised a lot of capital through convertible note investment and angel investment, even though I haven't won any pitch competitions. But the main thing is to know your skill sets and to reach out to investors. You don't ever know like who's gonna invest. There's a lot of people who seem like they're really well off, and you might think, hey, I only want to talk to like the flashy people or the people in these articles, but those aren't the people who necessarily will invest in your company. So recently, while I was in Atlanta, I met with a woman who was starting a new franchise, and I just communicated with her about my personal story. During that meeting, she said, hey, I'm gonna invest $50,000 in what you're doing. This wasn't an investor meeting. We were just meeting for the first time. So I really think it's important to tell everyone that you meet what you're doing. You never know who will advocate for you. And as Lauren mentioned, you have to figure out what kind of financing is best for you. So if you want to give out equity in your company, if you want to pay it back, or if you want to just focus on the grant financing, but it really depends on your personality, who you know, and what stage you are in business.
Okay, great. Thanks, guys. So we have a question from Ali Watts Davis. Is your excellent advice transferable to arts and social justice initiatives?
That's a great question. I think it is a little bit different. It depends on how you're building out your company. So a lot of times we're actually seeing the industry move towards these organizations where they're making money, but they're also giving back. And actually, Black Women Talk Tech is one of them, where we bring in revenue, but we're giving back at the same time. And there is opportunity there for investment, but it really depends on how you build out your company. So if you're building out a nonprofit and you really wanted to do a traditional way of creating, let's say, an arts program for kids in school, you're not going to go to investors for that. You're going to get donations or grants from people to raise money that way. But say you want to build up the next Tom's shoes, where Tom's is making money, but for every shoe that they sell, they give back. That's a great opportunity. So if you can turn that into an opportunity where your investors, remember, will be making returns on the money that you bring in, then absolutely this is transferable.
So yeah, I definitely agree with Lauren. There's a social justice fellowship that just opened applications called the Roddenberry Fellowship. So they just sent out the call today. So I definitely recommend any change makers to go apply to that particular fellowship. Also in the arts specifically, there are a lot of government grants. So I definitely recommend getting all of the certifications that you can so that you get more points on the application evaluation process. And then if you actually have a revenue generating company and have stable financials, all of the debt-based approaches will apply to you.
Okay, awesome. Okay, we also have a question from Felicia Hazard. What do you think of collaborations with companies of interest while preparing a startup?
Can you clarify that a little bit in terms of companies that are similar to your own? Is that what the question is?
Felicia, are you there? I'm assuming that's what she means, but I'd like her to clarify, maybe. So we'll give her an opportunity to clarify her question. In the meantime, I have a question that has been submitted, kind of. So when it comes to equity fundraising, how do you determine the percentage of stake to allow an investor to take in your company?
That is the $1 million question, truly. So as I mentioned in this process, the amount of equity that an investor is going to take depends on where they come in. So like I said, with angel investors, they're usually at the very beginning, meaning that they're going to take a bigger piece of your company. They could take 20, 30% of your company because they're taking such a big risk on you. You haven't really proven anything out. In the later stages, what happens is that you come up with a valuation. So the more investment that you get and the more people who say, you know, I really think that this company is worth $5 million, that is going to determine what your value is when you get to those venture capital stages. They'll look at how much the percentage that people took for the money that they gave you, and they'll use that to determine how much they're going to take later on. It is truly a black box. There is no science to it, to be honest. A lot of it has to do with how much revenue that you've brought in. Oftentimes people will say, if you have an X number of revenue, let's times that by 10 or let's times that by 100, and that's your value. But it really depends on where you are in that process, what the other people think your value is. I mean, that's like really most of it is like, what is that person going to give you for this? And then what are you willing to give up as well?
So just to add to that, I think every person should decide how much they're willing to give before they have the conversations with the investors. So if this person wants half of your company, you're like, I will never give up half your company, there's no need to proceed with that conversation. So have a sense of how much you want to give. And then keep in mind, most investors are men. So if you said, hey, I want to maintain my women-owned business certification, I want to maintain my minority certification, and I want to raise multiple rounds, I need to be really savvy about how much equity I'm giving away. Beyond that, there are resources like AngelList and PitchBook. There's data that's aggregated by region and say, hey, the average valuation, for instance, of a fintech company pre-revenue in Southeast is about $3 million. So you could say, hey, I'm sticking to that. And it's okay sometimes if someone, you have to turn down money. So you have to be confident enough to say, hey, yes, I really need this 50,000, this 100,000, but I'm not going to give up half of what I'm doing at this early stage for that amount. So as Lauren said, there's no like exact science to all of this, but it's definitely necessary to do your own gut check first and just eliminate anything that doesn't sit well within that gut check.
Okay, great. Thanks for that advice for that question that was out there in the world. But Felicia actually got back to us. She said that, yes, in reference to your question, Lauren, is collaborating with companies similar to your own. Yes, with companies in the same field to work, for example, such as breast cancer survivors. So her question again is, what do you think of collaborations with companies of interest while preparing a startup?
I think this really goes back to your own strategy. It's really dependent on what your company is building and what their mission is. So I'll say from the two different aspects of the companies that I've built. For Keep Up, we weren't really collaborating. Of course, I was talking to people in the industry, and I think always keeping founders close to you so that you can understand what they're going through, you can share your struggles, you can get advice from them. That's really important to me. I've always talked to people who in my industry and made sure that we were friends, and you never know where that's going to go. It could lead to an acquisition later down the line. It could lead to that person joining your company. So keeping those lines of communication open is great, but they were my competitors. I was not going to be working with them and giving away my trade secrets either. But for Black Women Talk Tech, it's very different. And it seems like this is similar to what you're asking about, in that we're very collaborative. We reach out to every single organization that is similar to ours and has a similar mission, because we know together we're stronger. And we know that there's no point in having competition. If we work together, we'll get to our goals faster. So I think it really depends on the company and where you're going and your overall strategy.
Great. We have a question from Nicole Lazar. She said, are there types of financing such as crowdfunding or grants that are more suited for developing and testing an idea? And how do you raise financing off of projections and estimates? That's actually a really good question.
That's great. So I would say if you're testing an idea, I would most likely do crowdfunding out of the two of those, because a lot of times with grants, there are different stipulations that you need to have. Oftentimes they want to see some sort of traction or some sort of development before you get them. That's not always true, but with crowdfunding, you can kind of put an idea out there, and if people like the idea or they like you, you're more likely to sort of get money. The other side of that, though, is that crowdfunding is not just that you throw something up and then all of a sudden everyone gives you money. There is still some work to it. You still have to have a campaign. You still have to really go out and build the excitement around your company or your product in order to bring that money in. And Rashawn, I don't know if you have other thoughts there. You're the queen of crowdfunding, so feel free to jump in.
Yeah, I mean, you're completely right. So for like donation-based crowdfunding specifically, that's a good place to test if people are interested in your product. So you can actually put your idea on there and say, hey, if you invest in my donation campaign, I'll give you one of these products that I create. And you can decide, hey, if you don't reach your goal, you won't go down that path. But everything that Lauren said was, spot on.
Where is GoFundMe in this list of like fundraising? Does that even qualify as fundraising for your business, like a GoFundMe?
Yeah. So that's a donation-based platform, and there's lots of different donation-based platforms. Some are just for artists, some are like highly vetted. They need to evaluate your company. So you really have to do an analysis on what's right for you. Also in the donation world, some are like all or nothing, and some you get whatever you raise. So it really depends on you. And as Lauren mentioned, it's not like if you put your idea or campaign online that the investors will come. You actually have to do a huge campaign to get your advocates in line with their commitments prior to launch, no matter what you do. So that is what you need to focus on. You need to make sure you have a great story, great video, if you're doing donations perks. But any of those donation-based platforms you can use depending on what kind of idea you have for donation. Again, product is better than, like, say, a fintech platform or some kind of biological device that most people don't get. For those, the other equity or debt-based are better. But if you have a product that you can ship and whatnot, those are better for those kinds of platforms.
Okay, great. So what are some tips that you can give on how to successfully pitch a startup idea to an investor? Does the pitch technique change based on the type of investor?
Yes, so I guess I'll start with that one. So definitely do your research in advance. If your investor is into fintech and you're a company that does baby products, your pitch would be different, but definitely do research on what the investor is interested in, figure out their other portfolio companies if you can, and point out similarities to that person in terms of either background, experience, or products. And definitely modify your pitch to your investor. The most important thing is to be confident and passionate about what you're doing. It doesn't matter if you leave out a sentence in your practice pitch or not if you are confident, because they will ask you follow-up questions.
Yeah, I love that. I think your pitch is really just a living document. So every time that you go in and pitch, you're going to get some feedback, positive or negative, and use that to make it better the next time. I think I have probably over 100 versions of a pitch deck in my computer right now, because it's constantly changing. Like Roshana said, depending on who you're talking to, you want to make sure that it's speaking to them and speaking to their interests. In terms of building it out, there are a lot of different resources online where you can find what a good pitch deck looks like. I mean, you can look at everything from what Facebook's first pitch deck looked like to Beautiful.ai has a really great structure where they show exactly what each slide should be about. You don't want to make it into a business plan. So you don't want it to be just reading tons and tons of words about what you're going to do. It should be inspirational. It should show your passion, and it should show your overall vision of where you're going. Those are the most important pieces to your pitch deck.
And what was that website again? Beautiful.ai?
Yeah, they have a really great link that shows you exactly every single slide you need in your pitch deck.
And just to add, like, I design all my pitches in Canva. Like, if you have a really beautiful sense of how you lay out the deck, it goes a lot further. So, and Canva has, tons of templates on how you can do that. So one of the, I guess, a special sauce is just to have really good design. People don't really tell you how important that is, but it actually goes a really long way.
Okay, so here's a question. Is your credit score a factor in obtaining funding from investors?
Yes and no. So your investors are going to do background checks on you if they're giving you money, especially in the later stages. Maybe not an angel so much, but definitely once you get into those seed and venture capital stages, they're going to give you money. But they also understand that building a business is hard, and oftentimes you're putting stuff on your credit card or you're making financial sacrifices to do it. So it's not really going to play into, it's not going to make or break you whether they're going to give you money. I think the conversation is a little bit different with debt. And Rashawn, I don't know if you know more about that, but for traditional equity investors, they get it. It's not that big of a deal for them.
Yeah, so yeah, Lauren was completely right. None of my equity investors asked to see anything credit related. However, if you are doing debt-based financing, that is a part of the process.
Okay, great. So here's a question. If you're at the fundraising cycle, if you're at the idea place or early on in your startup idea, what are some resources that we can use to learn about incubators or accelerators to help us get our idea off the ground?
That is a great question. So there are a lot of different places you can go. I really like F6S. So they sort of aggregate all the incubators, all the accelerators, every kind of pitch competition or grant for startups all in one place. And then you can even apply there as well. Sometimes you can do like a group application for some of them. So I think that's a great way to see what's available in your city, in your hometown, because oftentimes a lot of these incubators and accelerators are local. And then also streamlining that application process. Resource, yeah.
Okay. All right. So here's another question before you guys go here. So, which stage of the fundraising cycle should you be in when seeking investments through pitch competitions like 43 North or the New Voices Fund?
Yeah, so they're all different. It really depends. There are some pitch competitions where they literally just want an idea, and there are some where they want you to be making revenue. They want you to have raised money beforehand. Interestingly enough, the 43 North competition shifted over the last couple of years, in that when I first started, it was an idea competition, and now they want you to have raised $500,000 and be making money. So it really depends on that competition, but there are, at any stage that you're at, there's probably a pitch competition for you.
Yeah, and the best thing is to research who won previously. And again, I've been to pitch competition where the person that had the least amount of revenue won because they had the most passion. So it really depends on not only the past winner, but who are the judges and what gets to them, right? So, but as Lauren said, there are competitions for every stage.
Great. So William, do we have any more questions from the participants, or are there any raised hands that we can call on? I can give them time to join.
I don't think we have any other questions from participants.
Okay, great. So I don't have any other questions on my end. I don't know if there's anything else you wanted to add as far as like your contact information. Maybe people are question shy, webinar shy, and may want to ask you personally later on, if you could provide us with that so we can keep in touch.
Absolutely. So my contact information is on my slides. I don't know if you can still see them, but it's just Lauren@blackwomentalktech.com, or you can find me at Lauren G. Washington on LinkedIn.
Hi, everyone. Again, I'm Dr. Rashana Novelis. My website is IEnrichHer.com. We have a funding list that we update every week that has over 100 different opportunities. So you can just find it from our website and follow us at IEnrichHer on Facebook, Instagram, and LinkedIn. Also, you can email us at hello@IEnrichHer.com.
Okay, great. Well, thank you so much for, I remember when I was speaking with Lauren before we decided on the topic of tonight's webinar, and she literally said exactly what I was thinking we were going to talk about tonight, because this subject matter is so important, and for us to bring real life numbers into this conversation about Black women in business and how, you know, how predominant we are in starting them, but how we don't always get access to the capital that we need. I think this is such a great resource for everyone that joined, and for everyone that's going to see this probably later on to come to. And I want to thank you both for joining us tonight and providing such great information.
Thank you so much for having me. This is incredible. Really excited to be here.
Okay, I'm going to turn it back over to Ms. Mathis now so she can give the closing remarks, and just thank you guys again.
Thank you.
Good evening. Thanks so much for joining NCNW this evening. I learned a lot. It is a relatively mysterious topic, and it is so uplifting to see such young, vibrant women talking with such authority about raising capital and helping Black women grow their business enterprises. One of the reasons we do this series of webinars is that we want to demystify some of the things that you may see in the Wall Street Journal or hear in the news, in a safe environment where you can ask questions. I mean, one of the questions I have is when we talk about angel funding and venture capital, I think high tech. And I just wonder if you know of sources of funding, sources of capital that may be interested in more traditional kinds of businesses. Is everybody looking for a unicorn, or is there someplace you can go if you've got a restaurant or a boutique or something that you want to do that may not be quite as innovative? That's one question that I know people have all the time. I hope that you will be available to us in the future. We've got a big event coming up November 9th through the 11th. Our national convention will convene in Washington. We expect 1,000 guests to come. And one of the ways we're enticing people to come is we're hosting a pitch competition of our own. We don't have hundreds of thousands of dollars to give away, but we've got some very interested members who want to learn more about this topic, and we say, well, we'll just throw a pitch competition and see what happens. That application is available right now at ncnw.org. It'll be November the 9th, Friday, November the 9th, right here in Washington, D.C. Thanks again to everyone who joined us. We hope that you will come to the convention. Thank you, Clara and William, for your assistance. We don't know what we would do without you. And Celeste McCall, you are my angel. You've made this so much easier. You found great speakers.
Yeah,
The materials will be posted at www.ncnw.org. Visit us on social media, on Facebook and Instagram, Pinterest, and all the rest, where you can learn more about what we're doing here at NCNW. Of course, we've got an elegant legacy. Mary McLeod Bethune's statue is slated to go into the United States Capitol next year. She will be the only African-American woman representing a state. She'll represent the state of Florida, where she will replace a Confederate general as representative for the state of Florida. The legislature voted for that earlier. I've seen the marble. They went to Italy to quarry the marble. They got it from one of the same quarries that Michelangelo used to sculpt the David sculpture almost 1,000 years ago. And so we're excited about that. But while we are energized and fortified by the past of NCNW, I'm here to tell you tonight that we are firmly focused on what the future looks like. What does the future of work look like? I was in a McDonald's this morning, and instead of having 3 people taking the orders, they had 3 computers taking the orders. That means that those low-tech jobs are gone most likely forever. We can't be afraid of this new world and these new opportunities. I know we have the ability to do it. We are just as smart and just as brave and just as conscientious as any people in this universe. We just have to dive in and not be afraid. I'm so delighted that we have these 2 great examples. Yeah. I went to school about 7 miles from Chapel Hill, and so I know how rigorous that education and that institution is. Makes me very pleased to be able to present this information. We hope you'll join us tomorrow, where we've got another webinar scheduled. Celeste, I'm not sure I even know what the topic is. So, I know it's aimed at millennial entrepreneurs.
Yes, so tomorrow, this is like the great matchup of this week's webinar. Tomorrow is about crafting a pitch. So how to craft a perfect pitch in preparation for November 9th pitch competition. And that's why I was asking a few, since we have some pitch, experts on the webinar tonight. That's why I was asking some of those questions. So I hope you guys will join us tomorrow morning for that. It's pretty exciting.
11:30 to 1, spend your lunchtime with NCNW. If there are no more questions, we'll, and if our panelists have Lauren or Rashana, anything else you'd like to tell us before we wind up for this evening? No? But we appreciate what you've done. Come visit us when you're in Washington. We expect you to come by and see us at 633 Pennsylvania Avenue. Thank you all for joining us, and good night.
Night.
Thank you.
Bye-bye.